Right now, we're going to get into our analysis on the gold market. And I'm going to bring you something in here that I think you're going to find fascinating as I switch around into the charts again. And we're going to now look at a gold chart that I'm going to do a little teaching on here, because so many people ask us about cycle analysis, and how do you start? How do you place the timing tools like the cycle brackets that we use? So I'm going to switch over and put up GLD so that you can see. This was the McDonald's chart. And here you go. Here is, I'll zoom in a little bit. Here's a GLD chart, which is gold. This has on it 3 moving averages that we look at, and the blue one right over there is the 34 week, which is often a magnet, as you could see how it moves up and down to the 34 week so often. So when you look at this, you could say, okay, I could see it's rallied and sold off and rallied and sold off, and there's waves in here, but how am I ever going to understand what this ever means? And I'm going to try to bring you that type of information. So yes, I can see lows in here and I can see peaks in here, but what does that mean for measuring money flow, which is cycle analysis? What does it mean for understanding what the conditions are and what's the likelihood of it moving up again after this correction we've had, or continuing to move down? Well, let's take a little look at that. So what I want to show you is the next kind of a next layer in here, as I put timelines in here, and you can see that now all of a sudden we're looking at recurring rhythms in the market, in this gold market, that you can see. And there are key lows that we look at. You can see the low here and here and here and here and here and here, and those average about 50 weeks between each of them. So that's what a cycle is. It's measured from low to low to get the individual cycle. It's like an oscillator, essentially, that electronic oscillator, where you could see the rhythms in here. Or if it was like a heartbeat monitor, it would be the same thing. And that's the heartbeat of the market. Ba-boom, ba-boom, ba-boom. That's how it works, and we do what we can to measure that. If a cycle was absolutely ideal, what it would do, it would rally, about halfway up through the cycle, and then it would come down the same thing, about halfway down through the cycle. So that would be your ideal cycle. And then the next one would go halfway up and then halfway down, and the next one halfway up and then halfway down. Those are called ideal cycles. But what happens is that a force acts on these cycles, and the force is the money coming in and money coming out. And sometimes, instead of going up and down through half the time, it goes up for a much longer period of time. And that is called a right-hand translation. So it gets pushed up, as you can see right over there, and then the same thing here gets pushed up, and the same thing. These are positively configured cycles in right-hand translations, because the peak is way on the right side of those cycles. You can see that when it peaks on the left side of the cycle, it's negative and then goes down for the whole period of time. Man, I'm giving you a lot in here that gives you a good understanding of that. So we use cycle brackets instead of these lines, but you could really use both. And here is the analysis right now on the GLD market, gold. And here is how we look at it, looking at the 50-week cycles, and that's the big dominant bracket you can see right over here. And then there is a 25-week cycle right in here, and we have marked off the 50-week cycle as it traded and the 25-week cycle as it's trading. So what I just showed you, and what I want you to do as you get more and more interested in this, is go to the askSlim website and go look at our cycle analysis workshop. There's a video in there that tells you more about this, and it tells you about our 20 different video modules, and then you could take that workshop if you feel like you're ready to invest in that. So you could see in here the cycle rhythms very clearly. Now you had, an upside cycle right over here, bullish, right, really positive. This was an anomalous break from when COVID hit, so it didn't really even break down. It got close to it there, and then continued in the same rhythms. But something now has happened. and that is, like I showed you in that earlier cycle where there's a rally and then it peaks early and then comes down, once it breaks that previous cycle low, the odds are extremely high that it will continue to trade down through this entire period. That makes the next major low, or the bottom of this cycle, the big one, and the bottom of this second minor cycle in September of 2021. So that occasionally there are cycle shifts, and I talk about that in the workshop also, but what that says to me is that there is downside risk in here. Now what we do is use our swing high, swing low analysis to create resistance zones when it's negative. When it's positive, we create support zones. And you could see it got up here into that resistance sell zone. And it's a sell zone because this is negative. You can see in here the whole moving average, our momentum indicator, giving you a negative condition right in here. And with the breakdown, it is suggestive of the minor cycle coming down here into sometime in March or beginning of April. And you could get down to 165, that's about 7-8 points, or even down here to about 157. So this does not tell a very good picture for the gold market. Of course, we always want to know when our analysis could go wrong, and that would be if the first positive warning would be over the 78.6% at about 180. So if it got over 180, about a little over 7 points to the upside, that would be a positive warning. It would not be a repair unless it got over this level right over here. 183.53 is where that repair level is. So right now, it is clearly negative to us. Everything that we look at is negative. Momentum in here is negative, and it suggests that a choppy downward market in here. And if the correlations that are inverse to the dollar come back, because right now they've been correlated in a way that they're both declining, gold and the dollar, then we think the dollar market is about to rebound, and that might put some downside pressure on the gold market. So this is a negative scenario we're looking at in gold. We said we look out about 1 to 3 months, and that's what we're doing right in here, as you can see. We're going to call for continued pressure in the gold market all the way out for the next 3 months, and that right there is an example of the just beautiful cyclical analysis in GLD, the gold market. And I really encourage you, once you learn this, you will never look at charts the same way. So gold not in good shape right now. It will tell us if it's fixing itself, but right now it's not. So I wanted to give you that good look at the gold market in this 1 to 3 month view.